Welcome, everyone, to this month's episode of the Real Estate Roundtable right here on Move Smartly. As always, Steve Saretsky from Vancouver, real estate broker, agent extraordinaire. Thanks so much, Steve, for jumping on again today.
Looking forward to it. Looking
Yeah,
forward
and
to we're keeping this
we're
alive.
keeping the roundtable going. Mr. Ben Rabbit, who did not join us this month, but we have David Larock, who many of you might recognize from I host a live market update here on Move Smartly on YouTube. You can click the live link. So Dave joins me for that. And he agreed to join the roundtable this month. Thanks so much, Dave, for jumping on.
Thanks for having me.
All right. So, I mean, let's kick things off just kind of the way we normally do. Maybe just looking at Steve, kind of what has happened housing the past month, kind of in Vancouver. I don't know if you want to kick off or you want me to kick
Yeah,
off.
yeah, yeah. I mean, yeah, I don't know. It's funny. Like I was looking at, I think it was National Bank put out a report, and I think StatsCan was talking about it too. Like if you look at the latest GDP number, it was like, oh, residential investment was up like 7% annualized on the precipice of basically a rebound in home sales. And I was like, oh, okay, interesting. Like, everyone's kind of all excited about the direction of where home sales are going. And like, if I look at Greater Vancouver, we had sales were down 15% year over year in the month of November. So like a pretty big drop off of what was already a pretty low number. I think we were about 25% below the 10-year average. So like home sales, um, again, I'm not really seeing a whole lot of a rebound there. I think you can argue that they've kind of bottomed, but they haven't really rebounded. You have new listings down slightly, like 2%. So like new listings seem to have stabilized, but inventory's up 5%. But overall, like if you look at inventory, it's been pretty steady and stuck at about eight months of inventory, right?
Oh, wow.
So
Okay.
yeah, I mean it's high, right? I mean we're used to having like 2 to 3 to maybe 4 months of supply. You got 8 today. So
For all house types, like
uh yeah,
houses
so
and
eight for all property types. So if you take detached, apartment,
yeah.
townhouse, you lump them all together, you're at 8 months. I think ironically is that I think condos were at 7 and then detached was actually higher. But to me that doesn't really line up with what I'm seeing.
What are you seeing? Like, what's the difference?
Well, I think the challenge with the detached, and again, I think what you see is like you see a lot of like houses that are like up for like a land assembly that just sit there, these inflated values, or you have like a lot of like high end houses, right, that are like 4 million, 5 million, 6 million that just sit and sit and sit. I think if you're looking in the broad scope, I would say like the condo market to me is still the weakest segment of these property types. The data doesn't necessarily show that, which is pretty interesting. Like the data, when you look at pricing too, like I think so. I'll give you like, um, if you let's take the median price. Detached was down 7.5. Condos were down 1.5, which
That's
is
so,
just like
yeah,
not accurate.
it's so wild because I feel like it's very similar here, where the numbers in some ways are a little bit more bearish for low rise than they are for condos. Like if you look at
Mhm.
low rise, so that's like semis detached townhomes, um, prices are down 9-10% year over year, whereas condos are down, I think it's around 5% year over year, right? And condos certainly has more inventory, more sitting inventory than detached homes. But it seems like there's more price pressure on houses, and it does feel a little bit odd. And obviously, prices are down year over year, but houses feel like they're selling a little bit more quickly, especially if you're priced all right. Condos have like virtually no showings, like it's literally like a ghost town. So it is interesting. And I mean, our sales, in the GTA, I was just looking at the numbers. I mean, if we kind of assume, this December is going to be like last December, we're going to have about 62,000 sales. And that's going to be the lowest since like the year 2000. So it is lower than
Is that year to
last.
date?
So I'm 62,000 would be like end of this up to end of December. Like if this December is like last year, then we'll have annual sales of around 62,000 for the
Okay.
whole of 2025, which is again the lowest volume in like 25 years.
Actually, you
We're
know what's funny? We're kind of tracking that right now. I think year to date we're at about 20, just over 22,000 sales. So call it 23,000. Like the previous low was like 25 in 2018. So like, are we gonna get 2,000 sales in December? I doubt it.
Mhm. Yeah, so it's interesting, and I think like again, the low rise segment being as sluggish as it is, I think is a little surprising. I think we talked about this last month, maybe a little bit, but yeah, I mean, I'm a little bit surprised. I mean, just the statistics, if you'd asked me a year ago, 12 months from now, which segment would have lower prices, like which would have a bigger decline year over year, I would have figured it would have been condos, to be honest with you. I'm a little bit surprised that it's low rise. Um, but that's kind
What
of
do
the
you
market we're in.
what are you seeing? And I'm curious, Dave, your thoughts here in a sec. But like, it's interesting because I was like, obviously, if you ask me, like, hey, if you're a listing agent, what do you prefer? Do you want the $1 million condo listing, or do you want the 1.5 million detached or whatever? You take the detached all day long, right? So, despite what the data is telling you, I think that's kind of like more noise than it is reality. Which is interesting, right? I mean, that's where it comes down to, like, this is kind of always like my thing with, like, a lot of these economists are doing their best jobs at the big banks, but like at the end of the day, like, you're just taking in a data set and you're trying to interpret data. Sometimes you have to sort of be out there to say, okay, is this data actually aligning with like the anecdotes or the market reality on the ground? And I don't think it is. But seeing a lot more downwards pressure on pricing for detached of like building lots,
Mm,
like guys that would normally come out and build, they would, a lot of times in the city, they'd buy like a old tear down detached house, and that would typically get built into like a duplex, or in some cases now the multiplex side. I'm just finding those land prices have come off quite a bit over the last 6 months.
yeah, I've seen some, I mean, what I think are insane prices for land, like prices that are way below like 2000 COVID, you know what I mean? And
Yeah,
sorry, not 2000, whatever, 2020.
2020. Yeah,
Yeah. So yeah, just and again, no one's buying that because there's just so few, like no one's buying those properties to renovate them as a single family home because they're mainly land value, but there aren't a lot of people building. So the builders that are out there can just lowball, you know what I mean?
yeah,
And get what I think are serious discounted prices, like for the locations that they're in.
totally.
So
A
yeah,
lot of low balls.
for sure.
Guys, speaking of another anomaly, um, StatsCan said in the latest CPI data that average rents went from up 4.8% in September to up 5.2% in October. A lot of people were shaking their heads at that. Is that another one that doesn't sort of smell
Yeah.
right based on what you guys
100%. Yeah,
see?
that doesn't line up. Interestingly enough, I think they just published a report showing that asking rents are actually down. So this has to do with how
Oh,
they
did they?
yeah, like just today or something like that or yesterday, literally like just on but again, this
So what
report
are
is
John, what are they doing? Citing rentals.ca
it,
data?
it's almost like that for this report, yes, but for their CPI for the rent stuff, I wrote a LinkedIn post on this or a blog post. I like what's happening is that the CPI stuff is based on the labor force survey, which is again a small subset of the population, and only a small subset of people who get that survey have to answer questions about rental housing, right? So the people who are responding, the sample's very small. But then as part of their methodology, they have to do this kind of this statistical analysis. So they call it like quality adjusting, right? Which is basically, if units improve, they got to look at what the rent would have been on the unimproved unit, not the improved unit, if that makes sense, right? And I think when they do all of this statistical analysis and sort of quality adjustment on small number of transactions, I think it's probably skewing their results. So yeah, it's kind of screws up the data because you're right. It's showing that rents are up during a time where rents nationally are largely down. So it's like, is this going to fall out of the CPI at some point, and help the CPI numbers? Because it's obviously kind of pushing them a little bit higher than they otherwise would be if this data was actually more
I
accurate.
think the rental stuff, though, they correct me if I'm wrong. I'm quite confident of this. Anyways, they effectively they just survey property managers, right?
No, not for the CPI. I think it's all based on the labor force survey. I'm pretty sure.
So I know CMHC's rental stuff, whatever they put out, that is
Yes,
a survey
that
of property
is.
managers.
Yes, I think that is. Yeah.
And so what they do there is they effectively, I like literally just met with the CMHC's economist in Vancouver here, and he was like, basically they will survey the property managers, and the challenge is they do a lot of it's like turnovers, right? So it's like if you had some old lady that was in her condo for 13 years and then she like suddenly decides to move or passes away, like her rent controlled unit at, her one bedroom renting for $1,200 turns over at 1,800 to the next person that moves in, right? And so it's like I think that's what they're capturing. But it's like if you look at like the asking rents, which is rentals.ca, they're just measuring like what are landlords asking for rents today on vacant units, and you're seeing that obviously gap down in the double digits.
Yeah, that's a good point because you're right. It could be capturing turnover because you're right. If units are turning over, the actual market rent is going up
Yeah,
on that specific unit, 100%.
which I
So
don't think
yeah,
most people care about, right? I think most people want to track like if I could get 2,500 last year, what can I get this year? And it's not 25, it's 22, right?
yeah,
Like,
yeah. And the rental market's super sluggish. I mean, we were just talking, especially like,
yeah.
now there's tons of inventory, very few showings. And I think this is kind of one of the reasons why most people thought the condo market would do a lot worse over the past 12 months, right? Because many of the people who own these are investors renting them out. But it's super interesting how things have evolved.
Seeing a lot of the developers too, just offering like developers of new purpose built rental that have obviously, bigger pockets and can sort of navigate these storms is like what I'm seeing is they're doing a lot more rental incentives, right? It's
Hmm.
like, hey, we'll give you your first 2 months of rent free, and we'll lower the rent a little bit, not a lot, but like we'll lower a little bit, give you 2 months free. Like we haven't seen that in
Yeah.
Vancouver in a long time.
Oh yeah, all these big companies. I mean, the big ones that are basically charging above market rents. Like 550 a square foot. When market's probably closer to 4. That's what they're doing. They're doing so many incentives because they want to lock people in at these higher rates. Um,
Yeah. Yeah.
I can
but
tell you a small and quick anecdote. My son is at Queens and Kingston. They had a heck of a time finding a place, and there were bidding wars and people getting gazumped at the last minute by higher offers. This was last year. They got a call from their landlord a few weeks ago offering to renew them, adding a year to their lease, which expires in May, and giving them a rent reduction. So I thought,
really,
wow,
Voluntarily.
voluntarily. If you'll
oh,
sign for
good for
another
you.
year, we'll cut your rent. It was a small amount, but to me, that level of capitulation this early on was noteworthy,
That's
especially
interesting.
for a market that was pretty hot the year before.
So, I mean, what do you think's behind that? You said in Kingston, right?
Yeah.
So, I mean, what's behind that?
University towns,
Yeah.
massive drop off in international students.
Okay, I was gonna say, like, is that impacting? I mean, again, I think maybe there's a bias here where we think of like the big run up in international students was in these shifty kind of colleges, these not so
Yeah.
much, U of T, Queen, like the big universities. So that's why I'm a little bit surprised because I thought it was in some of these smaller
No,
colleges, but you're saying
there
it's
was
even.
a Yeah, there was an article in the paper this week. McGill just cut 25 different sports teams. The problem is, I'll give the Ontario example. Doesn't apply to McGill, but I imagine there are similar pressures there. Doug Ford capped tuition for Ontario residents, for students who are Ontario residents. The university had to find that revenue somewhere else, so they started bringing in many more international students. and because they could charge what they wanted. And so, the law of unintended consequences. Congratulations, Mr. Ontario resident. Your tuition is capped, but now good luck finding a rental. And if you can, the cost of that rental is going to double. Are you better off? I don't know. I mean, so that kind of boomeranged because now that we're cutting back on international students, I agree. I think it's the Conestoga colleges of the
Yeah,
world that
exactly. Exactly.
Yeah.
Ben Rabideau always has them in his sights. He does a great takedown on places like that. But no, I think it is absolutely it's mainstream universities for sure. The level of international students has dropped significantly, and that's got to be affecting rents in those
I mean,
towns.
that's super interesting. Like I figured they'd be have some effect, but I guess I'm a little bit surprised because um to have that much pressure on the rental market. I mean, there's got to be maybe some other colleges, maybe in Kingston as well, that are being impacted, I gotta imagine.
Yeah,
But that's
yeah, I was surprised.
super interesting.
Still
By
building
the
a
way,
ton of rental.
But oh yeah, everywhere. I mean, that's the only thing that's going to keep construction going, I think, over the next
Yeah.
3 years, basically, the purpose-built rental segment. So,
one of the other points I was going to make relating to the wonky data we're seeing, there are examples where in the statistical modeling they don't have all the information. Like when the U.S. Bureau of Labor Statistics puts out their latest employment data, they do it the day after the end of the month. So you can imagine they don't have accurate data at that point, and everybody lives and dies by that headline print that gets released the day after. And to come up with that number, they have to use a lot of plugs, and the plugs are in many cases based on the run rate and the historical averages of some of the data. But at turning points in the cycle, taking a 12-month average of a subset of the market and plugging that in as your assumed level of performance for the month that just happened isn't representative. So that's why we're getting all these massive revisions in the U.S. employment data, because the plugs they rely on to put out these reports as fast as they can are no longer reliable because they're great if you're humming along. They allow you to get the data out faster, and they take what's happened in the past, and they, as my old boss used to say, if the weather tomorrow is a lot like if the weather today is a lot like the weather yesterday, then you can predict the weather tomorrow. But at turning points in the cycle, it creates a lot of wonky data and then you get these big revisions, and then people say, oh, it's a conspiracy. But the reality is it's not. It's just the turning point in the cycle is not captured in these assumptions, which are based on rolling averages, which are no longer relevant. So
right.
we're getting a lot of wonky data right now, it
Well,
seems.
speaking of wonky data, what about I saw your post. What about the latest GDP numbers? It looks like Canada's economy is on fire.
Yeah, yeah, that was funny. Well, when you read the headline, that's what you think, but if you read the data, it doesn't take long to pour cold water all over that first assumption. And it was interesting. The bond market really liked the report for about 20 minutes, and then not so much. The biggest reason why the GDP data was so impressive is because we had a massive drop off in imports. When your exports are basically flat, which they pretty much were, and you have a big drop in imports, it looks like your net trade is going way up. But the reason why our imports dropped so markedly was because in the second quarter, StatsCan noted that we made a large purchase. Let me find the exact wording here because I quoted it in my latest post. Oh, I'm looking at the wrong one here. Yeah, sorry guys. They attributed it to the one-time impact of the import of a large oil and gas platform module in Q2, which fell out of the calculation. So boom, there you go. You buy a large gas platform module in Q2, you don't buy it in Q3, you look amazing because your imports go way down, your exports hold steady, your net trade improves. The bottom line is domestic demand fell a little, consumer spending was down. The only capital investment we had was government spending. Businesses did not contribute at all to capital spending, and that's consistent with the latest business outlook surveys the Bank of Canada puts out. So there's really nothing there to hang your hat on in terms of looking for strength in the economy. It was just really a technicality.
So, but I'm kind of curious though. I think we've maybe talked about this 2, 3 months ago. One thing that I still find odd is maybe consumer spending's down a bit, but consumer spending is still relatively high, right? And it seems like there's this disconnect between people, how they're acting in terms of like how they're spending money in the economy versus their expectations. Like the expectations are very negative, right? And normally when you have like a very negative outlook on the economy, people tends to buckle down and they don't spend as much and they're getting ready for a slowdown. But consumer spending's pretty aggressive. Like, is this a disconnect between, people who are just, I don't know, bullish, don't think they're going to be impacted by tariffs and out kind of spending money? I mean, it seems like a bit of a disconnect. I don't know. I don't know what you guys think.
Well, that's actually explained a couple of ways. First off, spending is holding up, but the saving rate is going down. People are dipping more into savings, and credit card utilization rates, borrowing rates are going up. So basically, people aren't spending more because they're earning more. They're spending more because they're saving less and they're relying on debt. So that is not a healthy signal for the economy. The other thing is, there's a lot of talk about the K-shaped recovery. Basically, if you chart the recovery, it's going in two directions. If you're in the bottom 50%, you're feeling quite negative. You're worried about your job prospects. You're having trouble making ends meet because prices are too high. And that is a large percentage of the population. But if you own stocks and lots of hard assets, you're rocking and rolling. So in the US, something like I'm going to guess here, and I'll be excoriated because this is a guess, but it's pretty close. Something like 50% of discretionary spending is being done by like the top 5% of income earners. So the bottom line is, if you're making money in the stock market, if you own a lot of AI stuff, you got it made in the shade. But for the average Joe, and when they do these surveys, they call a lot of people. Most of the people they talk to are going to be, the odds are that the people that they survey are going to be in the bottom 50%, and they're miserable. But the spending data captures everybody, and the people in the top have it made in the shade. Right now, 3 and 4 star hotels are having a lousy year, but the high end hotels are crushing it, and you can't get a room there. So this whole
Interesting.
talk about a K-shaped recovery, it depends on where you fall in the income spectrum and whether you own hard assets.
I think
Interesting.
that kind of lines up, truthfully.
I think so too. Yeah. I think that makes sense. Yeah. Is that what you're seeing, Steve? Like,
I mean, I don't know. That's just general observation, but yeah, I think so. I think like I always find that like stat interesting. You're seeing like a lot of people that have been like in the news that are transitioning like from a lot of their like dietary choices, which is like going from beef to chicken.
mhm.
Or like Costco puts out those reports, right? That's like, oh, people are now choosing like pork because like they can't afford, the beef anymore. And then now the chicken prices are going up. And it's like, yeah, I mean, I feel like there's like obviously a cohort that probably isn't even really looking at the meat prices. And then you have other people that are like literally switching their diets because like it's what it is. So yeah, I don't know. To me, that feels accurate.
Well, as
I
long
don't
as we're
know.
not eating Campbell's 3D
Bugs.
3D printed chicken. I don't know if you guys are
Oh yeah, I
on a
saw that.
diet. Unbelievable. Anyhow,
I follow
um,
an economist, David Rosenberg, and he likes to talk about Hormel's sales of spam. You know that meat that they
Oh
sell in a
yeah.
can, and he thinks that that's a good
a leading
indicator of
indicator.
yeah, yeah.
Yeah,
Are
Well,
they up?
because the reality is spending is an aggregated number of everybody, but it's not proportional, right? Like the bottom 50% are really getting hammered, and I don't want to make light of that. There's a lot of unfairness in there, but the reality is spending can be strong, and people and the average person you randomly call can be quite miserable.
Well, I think we know for sure is that housing is, I think, still a big drag on the overall economy, despite what Stats Can or CMHC's data is surfacing in these reports. Annualized rent growth or rebounding home sales. I think there seems to be like John, like even like housing starts are still like relatively elevated. I think it was like a month or two ago, Carney's tweeting about like how the housing starts are up again this month, and it's like, man, like I don't know, everything I'm seeing. You look at the pre-sale data, and you know what, 25 new condos sold in the city of Toronto last month. Like there's nothing happening in the construction market other than a bunch of these developers trying to convert some of these projects from pre-sale to rental and keep the lights on, right?
Yeah. And I think that one of the challenges, a lot of these stats, like the Carney stat about the new housing market starts surging. I mean, a lot of these are national, right? And you have
Yeah.
like Atlantic Canada and Alberta and Quebec basically pulling up the average, while Ontario and BC are struggling and are negative. So, and you're right. I think Ontario, BC are going to continue to see a decline. I mean, housing starts here are trending down, and even with conversion of condos to rentals, like some builders are going to be doing that. I don't think it's going to get us back to anything close to construction levels that we saw in the past. And labor's kind of going down. Like construction costs are going down as a result of it. You know what I mean? But yeah, I don't think
I
we're going
think
to see that.
rentals are the next shoe to drop.
In what sense?
I think that like there's so much rental being built, and like as we've already talked about, like vacancies are rising, rents are falling, and the construction pipeline's still full, right? Which is like how many of these projects were started, 18 months ago when rents were 10% higher. And then on completion, they're gonna be like, wow, vacancies went from 2% to 4%, and my rent's down 9%. Like that's gonna be a huge dent to the pro forma. I mean, I can tell you like monitoring like the Calgary market, for example, has been tons of rental building there. Everyone just abusing the CMHC program for rental financing. And it's like, I think there's a lot of bigger developers, smarter ones now that are like pulling back and choosing to delay projects. I think so. I think it's coming, but you won't see that in the data for a couple of years.
Well, yeah, I mean, I think the challenge, I don't know how it's going to play out with the rental data, but at the end of the day, I mean, if we think about where the after a year from now or 2 years from now, there are no start. The only starts will be rental starts. You know what I mean? And
Yeah.
and that means the only completions, 3, 4 years down the road will largely be rental completions, right? And we're probably going to be in a period where the population will be growing again, probably not 1.2 million people per year, but 300,000. But, I don't know. I think it's going to be interesting. What I'm finding too is the rental data is very muddled. I mean, if you look at, micro rentals and small condos are doing far worse than 1,200 square foot, 2 bedroom, 2 bathroom, missing middle type apartments. You know what I mean? Because that second type of rental we don't have, but there are so many of these micro condos that are just kind of sitting there. So it's going to be interesting to see how it all
I was going to
evolves.
ask you, are you what are you seeing in like the downtown Toronto core? Like obviously you're seeing more companies require workers to come back to the office, 3, 4, 5 times a week. Are you seeing any sort of rebound in that downtown core? Or is it still just like a disaster?
No, it's definitely picked up. I mean, it's not like it was pre-COVID, but yeah, I mean, way more people are coming back. More companies are mandated. I mean, there's a funny anecdote we heard at I think it was at the Veritas conference that someone was talking about how one of the big banks required everyone to go back to the office. I think it was 4 or 5 days a week, and then had to hit pause on that because they realized they just didn't have enough office space because they had unloaded a bunch. And then all of a sudden you have, a big bank looking for hundreds of thousands of square feet of Class A office space. And that market as well is in this, in some ways like the K-shaped recovery. The landlords of like prime Class A office space are booming, zero vacancy practically, whereas everything that is like, B or C is struggling to rent out. So yeah, I don't know. I think it's going to be super. I
Dave,
think it is. Yeah, it is impacting it.
Dave, what are you seeing on the mortgage side these days?
Well, It's been a different year for mortgage brokers than real estate agents. We have a lot of or for real estate brokers, we have a lot of similarities. We're obviously both tied to the real estate market, but we've had a lot of 2020 was a very busy year. So there's been a lot of renewal and refinance activity with people coming out of those
This year,
mortgages. And
25, right?
yeah, 25.
Yeah.
So we've had a pretty good year, and I do find like the market isn't dead. It's when you read the paper, you'd be surprised if anything ever sold. And I realize that the overall stats aren't great, but I'm still doing pre-approvals. There's still today a guy bought this morning, one in my inbox. A guy had been helping for a while, an existing client, moving from Hamilton to Toronto to be closer to his office. Yeah, I mean it's been a pretty busy year in mortgage world. And Ben Rabideau had a chart showing mortgage originations, and mortgage originations now in this year will be second only to the peak years of COVID in terms of the amount of originations. Now, some of that is
26 is bigger now. Like there's even more renewals in 26.
yeah, yeah. Now, 26 will be the biggest gap between the borrower's existing rate and the renewal rate. So I don't know that will be as robust then. And also, if prices decline, then there'll be less equity for people to work with. People were able to they got get out of jail free cards, and they did a lot of refinancing when prices were going up by 5 or 10% a year. And if the market is slower now, there may be less of that. But we're a bit more diversified because we have that refi and renewal volume. So maybe next year that volume slows down, but the purchase stuff picks up. Because again, quoting what Ben said in a recent call he did, I subscribe to his website. He was saying how the real estate market feels like a bit of a coiled spring. There's a lot of pent up demand, and ultimately, rates have stabilized to a point where they're not as restrictive as they were, and that, again, a lot of factors at play. But what do you think? Do you think 2026 will be a better year overall for real estate? Are we past the lows, or are we still?
Well, I mean, like John, I mean, you chime in, but I mean, like I'm kind of referencing like what you just talked about at the beginning of the show, which is 25 is going to be a record low in home sales over the past 20 years. So it's like, I mean, hard, and it looks like the same for Vancouver. So it's like, it's hard to imagine it being any worse from a volume perspective. Again, obviously prices could in theory still move lower. But you would certainly expect that volume should improve.
Yeah, exactly.
Unless
Yeah,
of course you have some, catastrophic downturn in the economy.
yeah, and I think one thing, I mean, Dave, you mentioned it doesn't feel like a terrible year. Like business is still okay. And I think we've talked about this with Steve sometimes, where sometimes it's very hard to disconnect what's going on out there versus what's going on in our own business.
Right.
K-shaped recovery for realtors.
Because yeah, like we're not, I mean, our year was okay. We were pretty busy. I mean, it doesn't feel like, in our business that it was a terrible, terrible year. But again, I think that's just a function of that we all do this stuff full time. We're not the part-time people. It's the part-time people, in at least in our industry, that are just not doing anything.
Bottom 50 of
Yeah,
out.
they're getting wiped out. People who do this full time are still quite busy. But I mean, to answer your question, yeah, I mean, I think it should be busier next year. It doesn't necessarily mean I think prices will accelerate. Like I wouldn't be surprised if we still see some pressure on prices in the first half. It's the second half for me that's a coin toss. I don't know what the heck is going to happen. And we were talking about this before the show. It's like you have like two of the big banks with two very different outlook for interest rates. So the CIBC's like expect two cuts in the second half of 2026. And, I think Scotia's like expects two increases in rates. So, the consensus on where we are, where inflation's going, I mean, it's up in the air, man. No one really knows.
I feel like the chief economist there at Scotia, Derek Holt, Derek Holt. Yeah, he's found himself as like the new contrarian.
Contrarian.
Yeah,
You know.
Scotia's always if somebody moves their forecast up, then Scotia will move theirs up the next day. Like they always want to be the most hawkish inflation forecast.
Interesting.
Quick correction, guys. Top 10% of US incomes account for 50%. I had to
I,
check. It
I
drives me
love that you're
crazy.
fact checking yourself real time.
Yeah, I said
Dave,
5%. Top 5% was 50%. It was top 10%. So I guess I don't know, maybe that was close enough, but for
Dave, I
the
have a
record,
question for you. What are you seeing on like the rate side from like obviously we're like, okay, CIBC is calling for more cuts next year. I think the market currently, like, broad financial markets don't have any rate cuts currently priced in for next year. So like let's just assume that the markets are correct. I suspect that things will change, but let's assume the markets are correct. That brings your variable today to what? Like most lenders are prime minus 0.7 ish. So your variable should be what, like 3.75?
high threes. Yeah, depends on if you're high ratio or,
Yeah.
uninsured. There's a range, but I would say something in the high threes.
But then your fix is kind of like what, high threes, low fours.
Yeah.
So it's like, I'm kind of curious what you see a lot of people, what you see a lot of clients gravitating towards. Obviously, like I get questions all the time, like, hey, my renewal's up. Like, what do you think I should do? Should I do like the 5-year fixed or the 5-year variable? Like, I guess I'm curious kind of the advice that you might give someone today. I know it's client specific in many cases, but
Yeah. Well, it's interesting, Steve, because when I have these conversations, people will say to me, here's the move of the day here. I'm going to go variable because I think the economy is going to slow. And when fixed rates fall as a result of the economy slowing, then I'll lock in a lower fixed rate down the road because I think fixed rates are going to fall because I think that we're in for another couple rough quarters with all this tariff stuff. And what I say to them is, okay, but the thing you have to factor in is that the bond market investors are forward looking and bond yields have already priced in all the stuff that you're reading about in the paper. And that's the part that I try to drive home is that if the level of fixed rates today reflects all of the information that you and I have available to us and have digested. So if you're reading an article on the front page of the Globe about a rough couple of quarters ahead, that's already in the price. So what I say to them is fixed rates might fall more from here, but if they do, it'll be for reasons that you and I aren't factoring in yet. It'll be because there's new information. So don't assume that the right thing to do is to anticipate how future rates will be affected by currently available information because that train left the station. The market has moved on. And the reality is people who go variable intending to lock in a lower fixed rate later find themselves in a tough spot because I've seen many times people in variable watching fixed rates go up and they get nervous because they didn't plan on staying in variable and the cost of their parachutes going up. And sometimes the fixed rates go up and then they come back down. But in COVID, you could have a variable at 1.5 or a fixed rate at 1.75. And people who had their variable rates at 1.5 were reassured by the governor of the Bank of Canada that rates weren't going to go up for a long time. And then fixed rates started to climb because the bond market saw all this inflation. And people called me and said, hey, I think I might want to convert to fixed. What can I get? And in their mind, 175 was the number they could have had when they took the 1.5 in the variable. And I look it up and I tell them, I'm like, 3.5 is the rate today. And they're like, what? I'm at 1.5. And if I want to convert to fixed today, I've got to more than double my rate. That's crazy. And nobody does it. Well, the variable rate goes to 6, and all of a sudden converting at that 3.5% rate was absolutely the right thing to do. And it's a bit like the boiled frog syndrome, right? The pot gets a little bit hotter over time, and all of a sudden you're dead in a boiling pot. So what I advise borrowers is if you want to go variable, don't do it thinking you're going to time the market. Do it because you're comfortable being a variable rate borrower for the long term. Because if you stay with variable for the long term, the odds do suggest that you'll save money. But people who go variable with a plan to time the market and convert to fixed later oftentimes end up converting to a fixed rate that's higher than the one they could have today. And that's why I tell them just decide which one you're comfortable with over the long term and go with that. Because if you think you can outsmart the market, And if your reason for outside smarting the market is that you're using front page news today, thinking it's going to affect prices down the road, then I try to unpack that level of thinking because I don't care what the future holds. That isn't, if rates fall in the future, it won't be for the reasons that you and I can see today. It'll be for new stuff happening that hasn't come across our radars yet.
You better be a professional bond trader.
Yeah. Yeah. And even those guys.
Yeah.
It's funny. I have a funny story. It was like literally the same thing of like you mentioned, is like people like panic at the highs. I remember calling like on a rental property I had. I remember calling Scotia. Like my variable had gone up, but it's a rental property and what anyways. So I just called to inquire. I was like, hey, like what does this look like if I do want to lock in? And she was like, yeah, I can take your 4-year mortgage left or whatever it is on there. I can switch it out for like a 4-year fixed at like 6.3. And I was like, oh, I ain't locked in at 6.3. That's crazy. I was like, that's the best you can do. She's like, that's the best we can do today. And I was like, wow. I was like, are people actually like taking that rate? I mean, that's people are actually calling you to like convert their variables to fixed at 6.3. And she's like, oh yeah. She's like, my phone's been ringing all day.
Yeah.
Like, you know what I mean? Like
And
people were just
Wow.
panic puking right at the highs and like locking in at
But
six. Of course, we're down to high
they're,
threes, right?
they're panicking probably because their variable was at 8 back then, right? Like
Well,
with
yeah.
if
I mean, I guess the variable would have gone
back
up to
then.
the
what,
variables,
7?
the variables hit now usually low sixes. Variable and
At the
fixed were
peak, at
pretty,
the peak, when fixed was at 6, weren't variable even high? Their variable was even
no,
higher than that, no?
no. No, no, the variables got up around 6.5. By the way, Steve, the worst case scenario for people is they have a variable rate mortgage with a major bank and they convert to a major bank fixed rate because then you lock in 6.3, rates drop to 4. The penalties the major banks charge to break their fixed rate mortgages are 4 or 5 times higher than what other lenders charge. So you are absolutely stuck. Like there is an iron door slamming shut behind you when you sign a fixed rate mortgage contract with a bank. And and those poor borrowers today are, like you said, people panic at the worst possible time. And, those people should never have taken a variable rate in the first place, right? Like, even the people who let it ride, who rode it out when the variable got north of 6%, today they're back below 4%. Like when you look at their average cost, it's higher than it would have been had they locked in a fixed rate. That, in retrospect, was the thing to do. But variable rate borrowers have received enough relief now that it isn't as horrible as it was. The worst case scenario is locking in and panicking at those plus 6% rates and extending term, which most of them did. Those guys are the ones who are most likely to be impacted. And like I said, I try to talk those borrowers out of going variable. To me, variable is a long-term play. It's a bit like you buy a stock, and my dad used to say, any stock you buy, you should imagine you don't even check the price other than once a year. And that was always his investing philosophy. And then, like it goes up or down, but you just own it for the long term. And variable is the same. You just got to stick with it. You got to ride it.
I would actually quickly, Dave, I was actually just question, and I'm sure there's maybe some of the audience is wondering. So like you have the biggest renewal wave in 2026 coming up. So those people that are renewing in 2026, I'm assuming like a lot of them anyways, would have taken 5-year fixed in 2021. And that would have been like the lows at what, 1.5% ish on average, maybe, give or take. So you're coming off of 1.5%. You're going to renew next year. Let's just assume the rates are basically the same. At call it 4%. So you're going to go from 1.5 to 4. I'm assuming there'll be a lot of people that will try anyways to say, okay, listen, I just paid off 5 years of my mortgage. I want to kick this back from a 25-year AM. I want to kick it back to 30. Well, the lenders typically look at it and say, well, hold on a minute. Your house in the suburbs of the GTA is down, 20% or 15%. We're not going to push you back to 30. Or will they typically just say, oh yeah, no worries. Like they don't go back and look at the LTV and they'll push you back to 30. Because you're not going to refinance for like a larger mortgage. You're just saying, hey, can I
Yeah.
push the term
Extend, yeah.
back out to keep my payment sort of stable?
Well, yeah. So lots to unpack there. First of all, if you want to extend the AM, it counts as a refinance, the same as if you're borrowing money or not. So
Right.
it has to be
Mm.
reappraised. And if the appraisal were to come in low, you'd have to be under 80% in order for, or 80% or less in order for it to work. So is there a scenario where somebody says, I want to re-extend my AM to lower my payment? They reapply, they've got the income, the appraisal comes in low, and the appraiser says no, or the lender says no. Yeah, probably. But from a lender's perspective, extending amortizations means you're going to borrow money for longer, our profitability is going to go up, and ultimately, we don't want you to default. And lenders are trying to find ways to help give borrowers relief. So I think there's probably a lot of flexibility built in there. And I suspect that deal probably gets done one way or another most of the time. But yeah, I mean, those conversations are happening. The interesting thing, Steve, my typical borrower, and I wouldn't use 1.5 as the rate that most people are coming out of. That rate was available, but that was the low. So let's call it 1.75. Let's bump it
Sure.
up a
Yeah.
little bit, and let's hope we're in the high threes next year. If you started with the 30-year AM, you paid the mortgage for 5 years, you paid off a lot of principal, and getting down to a 25-year AM, resetting, people say rates have doubled, so my payment's going to double. Well, the interest portion of your payment doubles, but the principal portion doesn't. So in reality, a lot of times it's about a 30% increase in your payment, at least today. As that spread widens, that changes. A lot of times if I can refinance someone and re-extend back to 30 years, I can get their payment the same or a little bit lower than I could before. So you're right to ask if that option will exist, but insofar as it does exist, you can basically immunize people from any kind of cash flow impact. And that's something that you don't read about that a lot in the mainstream media. It's not sensational enough and it takes a little
Hmm.
explaining. But funnily enough, and people are surprised to hear me say this, generally speaking, when I talk to my borrowers about their upcoming renewals, they start out pretty stressed and they almost universally end the call saying, I'm so relieved that's not nearly as bad as I thought it was. And I'm really glad that I actually have the numbers now because it's not as bad as I thought it was. And that is almost like the universal response. And you wouldn't know that from the headlines that you read in the paper.
Yeah.
Yeah, no,
Yeah.
100.
Yeah. John, go ahead.
I mean, one thing I saw was it may have been in one of Ben Rabbity's reports. I can't remember. I thought was interesting. I mean, kind of going back to the banks wanting to work with borrowers. I think he was talking about a sharp increase in HELOC balances. And I think he speculated or kind of give his thoughts on what he thought was happening was in some cases when these refinancings or these renewals were coming up, banks were basically kind of shrinking the mortgage portion of the debt, adding some of that to a HELOC because the HELOC is interest only to assist with payments or kind of keeping their payments at a constant rate, which I thought was interesting. I mean, I don't know if that's actually happening, but he thought that that might be part of it. And again, but I mean, to your point, I think everyone's, the concern, there's a lot of obviously worry about what is going to happen in 2026, but I tend to agree with you. I don't think it's going to be as bad. I think banks are working with households. I mean, the banks don't want power of sales to be going up. You know what I mean? So,
Yeah, that's interesting, John. So here's the thing. If banks are playing by the rules when they do that, it's harder to qualify for a HELOC than it is for a mortgage.
mhm.
So if if somebody is already stretched and you're trying to give them cash flow relief by making their payments interest only, the only way you do that is by qualifying them using HELOC underwriting standards, which are tougher. So to me, the kind of borrower who's stretched to make payments isn't going to be able to have the income to qualify for the tougher HELOC. So, I mean, they would have to be doing some stuff where if the regulator came around and opened the file, they'd be slapping somebody on the wrist. Um, the other thing about HELOCs is they're demand loans, right? They can be called at any time. Mortgage contracts have to be honored if you pay as agreed. But you could wake up tomorrow with a HELOC and the lender could just say, "Yeah, we're yanking it. You've got whatever 30 days to pay us out, and we want our money back." So they're a very different kind of loan. But yeah, I don't. If you're a stretched borrower and you have to requalify, that's not a solution I could offer you because the fact that you're stretched means you wouldn't be able to qualify by an even tougher standard, which you would need to qualify. And it makes sense that HELOC should be harder to qualify for. You can do more damage with them.
For sure. But I mean, I got to imagine the banks are bending the rules. I mean, they're giving out blanket appraisals on condos that aren't worth what, market. I think there's a lot of bending the rules to kind of
What
get
about
by would be my
the
instinct.
extended AMs on these fixed payment variables that everyone's effectively just ignored? That oh, don't
Oh
worry
my
about your
God.
AM being 70 years. We'll
Yeah.
just work with you and figure it out.
Yeah, that kind of sorted itself out. So that those mortgages typically hit trigger rates and the payments were reset. And there was a lot of noise about that was going to be the thing, and we were going to be like the US economy all over again. And there just weren't enough of them out there. I think on a macro level, it was happening, but
You think
that's
though, like it triggered the payment where it's like, okay, your payment goes up by a couple $100, so you're at least paying a tiny bit of principal. I don't know. I think it was at TD where they were basically
yeah.
pushing, they were deferring people's interest outstanding, where the
Yeah.
loan, the balance of the loan was growing.
Yeah. So I was helping some of the borrowers that I have worked with were TD variable rate borrowers.
Mm.
And at one point, like here's the bottom line. If you own a house that's worth $1 million and you've got a variable rate mortgage for 250K, and your variable rate, your payment was based on 1.7, and now you got to pay 6%, and your minimum payment isn't even covering the cost of interest. TD's more than happy to roll that shortfall into your mortgage each month because there's tons of equity. If you don't have that level of equity, then they're calling you saying you've got to increase your mortgage payments so that you're paying at least $1 of principal every time the rate goes up. So they're only doing those negative AM options when there's so much equity in the property that it's not a risky loan. And again, if you're a profit-making lending institution, increasing debts when there's tons of equity protection on a loan is not an insane thing to do. And if that borrower ever doesn't pay you, the magic of rising house prices says that you're going to get your money back.
Awesome, Dave. We're gonna wrap up. We're kind of approaching the hour, but before we go, let's
To
do
be continued.
yeah. So let's do a quick lightning round. We're ending the year. Where do we each think prices will be a year from now? December
Oh man.
2026. I mean, I don't want to say sales because if we said, I mean, if sales are pretty much at a 25-year low, we should be a little bit higher. But do we think prices will be flat, up, or down year over year in our respective markets? Steve?
Oh man, first out of the gate. I can't wait for like Twitter to clip this a year from now and say I was wrong. I'll say flat, flat.
All right.
I mean, probably, could you see some declines in the, like you said, John, could you see some further declines in the first half of 26? Yeah, quite likely. And maybe you start to rebound towards the end. But I think if you're looking at the home price index year over year basis, December next year, let's call it flat.
Larock?
GTA, I'm gonna stick my neck out. I'm gonna say a rebound. Let's go 5%.
Up.
Wow,
Yeah,
that's aggressive. I
You're,
like
you're,
trade
it.
trade deal, trade deal, and flat rates. A lot of the fear coming out of the out of buyer sentiment and some pent up demand. The Ben Rabideau coiled spring theory.
You do have
I
USMCA next year, and that'll
that's
be a
it.
big.
I,
So can I make a quick point about USMCA because this drives me nuts? The USMCA is not up for it does not expire next year. The USMCA was a an 18-year agreement. And
Mm,
every 6 years, the parties agree to go back to the drawing board and renegotiate. And in the event that they can't all agree to make changes to the agreement, the original agreement remains in effect and 6 more
mm.
years go by.
oh,
So if
okay. Interesting.
Trump could
Nice.
always just decide he's not honoring the agreement, and he might do that tomorrow morning after his breakfast. But if by rule, the way the agreement is set up, if next year we don't like any of the changes that are being proposed, we can literally walk away and it's 6 more years before we touch it again. So,
Hmm.
and yeah, I think for whatever reason that doesn't, that I haven't
It
read
doesn't.
that out there much.
Yeah, I didn't know that, and I think a lot of people that don't even get when they talk about the tariffs on Canada, it is non-USMCA like stuff that is not part of that
Right.
agreement that we're being tariffed.
And about 90% of what we sell to the
Yeah.
US is captured under the USMCA.
Anyhow, good point.
And we have the lowest
I-
tariff rate of any country. We're at 2%. Mexico's at 4%, our average tariff rate. So,
Nice. All right.
That is good. John,
It is.
let's
I'm
go.
gonna
Spill
I'm
the
gonna
beans.
wrap up. I am with Steve. I think we're gonna be roughly flat, maybe modestly down. And while obviously I can't predict the future on house prices, I can predict, or I will predict, that out of the three of us, the person who's gonna get trolled the most in the comments this month will be David Larock.
all right, bring it on.
Oh,
Yeah, it's
okay.
no fun. Well, you
No,
gotta
not
stick-
you, Steve. It's the person who has the bullish outlook is
I've
always
got a
the
target
one
on my
that gets
back
trolled.
already.
You know what else though, guys? I'm the only non-real estate agent, right? Real estate agents get crushed when they say the market's gonna do well, and the mortgage broker, I don't have the I don't have the same fear. I haven't
Beautiful.
been hit in the face so many times for leading with the chin, but maybe I will be after this one.
Beautiful. Alrighty, guys. Thank you so much. We will regroup next month.
Thanks,
Have a
John.
great holiday.